Welcome back. Wells Fargo just announced a few days ago in this article from their chief economist that the housing sector in the United States could get into recession here. It says rising borrowing costs stand to tip the housing sector back into a recession. Prospects for a housing rebound dim as mortgage rates turn up. So as of Thursday, the average 30-year fix was at 7.50%, down by about 50 basis points compared to about 2 weeks ago, but still at 7.5%. Rates are still very close to the highest levels since the year of 2000. So let's see what they have to say here, because I found this to be a really good snapshot regarding what's happening right now in the US housing market based on all the reports I've been sharing with you guys. And they provided their forecast of home prices through 2025. So stay tuned for that as well. It says the US economy as a whole has shown a remarkable degree of resilience this year despite high rates. A strong labor market and moderating inflation have raised hopes that the US economy can avoid a recession. Unfortunately, not every sector of the economy has been sturdy. The housing market, right? After generally improving in the first half of 2023, the residential sector now appears to be contracting alongside the recent move in rates. So obviously the housing sector is very much rate dependent. So when the Fed started raising rates in the spring months of 2022, of course, that caused rates to increase from 3 to about 7.4% by the time we hit October of 2022. And now rates have been above 7% for quite some time now. They also say here a higher for longer interest rate environment would likely not only weigh on demand, but also more or less just saying here, it weighs on the supply of houses as well. Very interesting dynamics right now. So generally when rates skyrocket, demand absolutely plummets, right? But because we had all-time record lows for rates back in more or less 2020 and 2021, a lot of people have this lock-in effect because they don't want to sell their house when they have a 2.6% rate like I have and take on an 8% rate. That would be, no one's going to do that. No one's going to sell their houses unless they really have to, or they have life events that is causing them to sell a house, relocation, job loss, death, etc., divorce. So in any case, higher than longer interest rate environment is impacting the supply side, but also the demand side as well. They have a really good chart here showing how the seasonally adjusted annualized rate of home sales of single family houses, according to NAR, is affected by the fluctuations in rates. So the blue line right here is the average rate according to Freddie Mac, going back to 2005. The red line is a seasonally adjusted annualized rate of single family houses according to NAR. So for single family, it's at 3.5 million for the month of September. Compare that to all housing types, which would be single family houses, condos, townhomes, and co-ops. That number is at 3.96 million. In any case, for single family at 3.5 million, more or less the lowest sales pace since approximately 2010. And of course, the reason for that is a sharp rise in rates, which really impacted sales. In contrast, when rates decreased from about 5% in 2019 down to about 3% in 2021, of course, home sales absolutely skyrocketed to a rate of 6 million. Now it's only at 3.5 million. Now, speaking of that, it says here, after perking up to start this year regarding sales, nearly every facet of housing activity has shown signs of relapse as the Fed has maintained a restrictive policy stance. In other words, higher for longer rates. And then also on top of that, they have been rising rates or have been increasing the federal funds rate for quite some time, ever since March 2022. And meanwhile, of course, mortgage rates have breached 7%. In September, existing home sales extended a 3-month streak of declines and dropped to a pace of 3.96 million. That's for all housing types, according to NAR, a 13-year low, as I reported to you guys, the lowest level since October 2010. Exactly what I mentioned in my video from several days ago. Something I also mentioned as well regarding applications for home loans has now fallen to the lowest level since 1995, according to the Mortgage Bankers Association, as he announced here as well. It says in September, the Fannie Mae Home Purchase Sentiment Index, that's a monthly report ever since 2010 that Fannie Mae conducts, they found that 84% were pessimistic about home buying conditions, a new survey high. Now, here is the actual report from Fannie Mae, because on the flip side here, it says in September, 16% of consumers reported that's a good time to buy a house, matching the all-time survey low that was set last year. So only 16% of consumers who responded to the survey said it's a good time to buy, an all-time record low, at least tied for that. So we have an environment in which people are pessimistic about housing market. And of course, a lot of people, or the vast majority of people, say it's a bad time to buy a house right now. Meanwhile, the NAHB, or the National Association of Home Builders, their index here, which is a measure of builder confidence in building or constructing new single-family houses, has been decreasing every month ever since July. So decreasing every month ever since the summer months here. And on top of that, builder confidence is actually pessimistic right now, below a reading of 50, which means builders overall are pessimistic. On top of that, their index of builder confidence is now at the lowest reading since January this year. So builders are not very confident regarding our housing market right now due to the rapid rise in rates. Wells Fargo also touches on what I mentioned in my video with Dan Frio a couple of days ago regarding the spread between the yield on the 10-year US Treasury note compared to the average 30-year fixed rate mortgage rate. So historically speaking, that spread between the 10-year and the 30-year fixed mortgage rates is around 160 basis points, which they say right here. But right now, and this has been going on for quite some time now, the spread now is 300 basis points. So it says here, the spread between the 10-year yield, that's a 10-year treasury, and the 30-year fixed mortgage rates followed historical, if it did actually follow historical averages, mortgage rates would be approximately 6.4% currently and not over 7.5% or around 7.5%. So in other words, what they're saying here is that historically speaking, the spread is 160 basis points or 1.6 percentage points. So given that the 10-year treasury yield as of October was at 4.8, average 30-year fixed mortgage rates should be at 6.4% and not 7.5%. They say here the spread between these two variables here tends to widen during periods of economic uncertainty and bond market volatility, but seldom has this gap been this wide for so long. So here's exactly what they mean by this, because the spread between the 10-year and the 30-year has been growing here. So the blue line right here is the average mortgage rate here for a 30-year fix. The red line is the yield on the 10-year treasury note. So as you guys can see here, the spread right now, in fact, or the past year here, the spread is very, very much wide here. A difference right now of about 2.99 percentage points or about 299 basis points. A very big spread here, which you can see right here. The purple line is that spread around 3 percentage points right now. Historically speaking, from about 2013 through 2019, that spread should be around 160 basis points or 1.6 percentage points. But because of all this economic uncertainty and the bond market volatility, the spread is actually greater right now than historical averages here. They also touch on the rising costs, which is causing housing affordability to erode further. So it says here the rise in borrowing costs has been a setback for housing affordability, which I talk about on the channel all the time here. According to the National Association of Realtors, the average P&I payment for borrowers using a 30-year fixed rate mortgage rate was $2,234 in August. I know we're in November now, but NAR just announced a couple of days ago, actually I should say last week, their latest numbers regarding housing affordability for the month of August. It takes some time to compile their data here. In any case, back in August, back when rates were much lower today here, the average payment was $2,200 per month, up 26% compared to the same month 1 year ago. So the average monthly housing payment is up by 26% compared to August of 2022, year over year. The increase in monthly payments has far exceeded growth in median family income. Again, I talk about this all the time, right? So again, talking about my video I made for you guys, look at this. Your P&I payment, again, excluding the giant increases in home insurance and property values as well, property taxes as well. The P&I payment, principal and interest, up 26% year over year, whereas the median family income only increased by 5%. So that is not sustainable to see that incomes increase by 5%, whereas your average monthly housing payment, excluding the increase in insurance rates, is up by 26%. Now, what they don't mention in this report here from Wells Fargo here is actually it's much worse when looking at August of 2019. So comparing August this year to August of 2019, your P&I payment, principal and interest, saw a giant increase of 116%. That represents an increase of $1,200 more per month to buy a median price home back then compared to now. Now compare this to incomes. Incomes only increased by 21%. Again, not sustainable. You can't have incomes increase by 21% and then have your average monthly housing payment surge more than double, increasing by 116%. And also, according to my own analysis here again, the National Association of Realtors Housing Affordability Index for the month of August is at a new all-time record low. But again, that's back when rates were only at 7.15%. And again, rates have been hovering around 7.5 to 8% for virtually all of October here. I mentioned that because housing affordability will likely look worse in September, and again, look even worse once they announce October's numbers later this year. All right, to take a step back here, of course, a lot of home buyers right now are facing all these headwinds. Of course, this is causing demand to basically fall off a cliff right now, right? Looking at applications for home loans, the lowest level since February of 1995. However, though, on the supply side, we're not seeing a giant surge of housing inventory, and that is really causing, supporting home prices so far right now. It says after declining throughout the second half of 2022 regarding prices, home prices have ticked up for the most part of 2023. For example, the CoreLogic Home Price Index has risen in each month so far this year, and as of July, it was up by 1%. One of the reasons why I don't really cover CoreLogic's HPI is that it's so lagging. So they just announced August numbers a few days ago at the time of filming this video here. And again, we're in November here. So I tend to not talk about CoreLogic's report here because it's very much lagging here. In any case, though, I think we all can agree, though, that home prices are still up compared to a year ago. And right now we're seeing a seasonal decrease in prices. But again, we're not seeing a huge fallout or crash in prices because of inventory levels still very much low, historically speaking here as well. Wells Fargo actually talks about this as well. It says another factor boosting home prices, I wouldn't say boosting, I would say another factor causing home prices to be higher compared to 1 year ago. Home prices are not boosting right now. They're going down. It's a seasonal decrease right now. Anyways, another factor boosting home prices is a remarkable shallow supply of houses for sale. I would add an asterisk here, only in the resale market of existing houses, not new houses. In September, the count of existing single-family houses for sale was 1 million, which equates to only a supply of 3.4 months. Although the month supply has gradually increased this year, I believe this is data from the National Association of Realtors, it remains below the 3.9 months that average prior to the pandemic. So right now we're at a month supply of 3.4 months. This means at the current sales pace, if no new listings were to hit the market, at the current sales pace, all the houses listed for sale right now would be sold in 3.4 months. Before the pandemic, they're saying here the month supply was at 3.9 months. It's also well below the range of a more balanced real estate market in the range of 4 to 5 months here. For context, the month supply peaked at nearly 11 months in 2010, a supply increase that coincided with a 26% decrease in home values. So of course, that's one reason why home prices tanked in 2010 due to a glut of houses for sale at 11 months versus 3.4 months right now. I mean, it's pretty wild here. The month supply back in 2010 was about nearly 4 times higher back then than it is right now. Now, speaking of the month supply, here's a look at the month supply according to the National Association of Realtors ever since 2004 here. So the month supply again is at, 3.4 months right now. This is well below the Great Recession levels we had when the month supply was over 10 months here. Also, when looking at pre-pandemic levels, which is right here, the month supply was around 4 months. So we're below levels looking at pre-pandemic and obviously well below the averages from 2014 through 2019, when the range was about 3.5 to nearly 6 months. In regards to housing supply, here's something that I found to be really interesting here though. And this is something I've been talking about on the channel for about a month or so, because inventory levels have been increasing here, which is highly unusual during this time of year. It says higher rates are contributing to the scarcity of existing houses for sale. Again, high rates is impacting the supply side, but also the demand side as well here. The leg up in financing costs, or the increasing in financing costs, has left 82% people who have loans on their houses. So about 82% of homeowners who have loans on their houses have a rate below 5% as of Q2 this year, meaning the vast majority of those with a mortgage would be trading a low rate for a very high rate right now. However, not every homeowner has a mortgage on their house though. So for example, roughly 42% of current homeowners own their properties outright, and therefore they may not care as much to sell their houses and take on an 8% rate, for example, especially if they're looking to downsize and move all their equity into a house that is more affordable. Wells Fargo also says here that inventories are likely to remain constrained for the foreseeable future. However, though, there are signs that inventory is starting to increase as sales are slowing down. During the week ended October 8th, Redfin's measure of new listings was down by only 3.9% compared to the same week 12 months ago, the smallest annual difference since July of 2022. I talk about this on the channel as well because new listings, basically fell off a cliff last year. This year, we are seeing this gradual decrease of new listings, but it's not decreasing at the same rate last year. And therefore, the year-over-year difference is actually getting more narrow here, especially as we are approaching here in October here. They do say, though, that total inventories, or the number of houses actually for sale, are unlikely to meaningfully improve in the years ahead, yet supply may gradually grow as the macroeconomic backdrop deteriorates and more sellers are forced to sell their houses or list their houses for sale. I've been saying this as well because I also believe we're not going to see a huge surplus or huge increase in the number of people listing their house for sale unless they're actually forced to. They're running out of money, they lost their jobs, they're forced to sell their houses and get their equity out in order to pay for everyday living expenses here. So we're not seeing that just yet, but stay tuned for 2024 here. They also talk about how the resale market of existing houses is much different compared to sales of new home construction. So for the month of September this year compared to last September, new home sales, as defined by the U.S. Census Bureau as a sales agreement signed between a buyer and a home builder, So this is really acting more like a pending home sale, surged 12.3% this September. What they do mention though is that builders are now reporting that buyer traffic has thinned. Buyer traffic subcomponent of the National Association of Home Builders Housing Market Index fell back to a reading of 26 in October, close to the cycle low of 20 reached in December of 2022. So we'll have to see if all these builder incentives that home builders are giving to home buyers in order to drive home sales, if that will continue given the rapid rise in rates. Now, here's what they had to say regarding their housing market predictions through 2025 here. It says that looking ahead, higher mortgage rates are likely to worsen affordability for home buyers and bring about a weaker pace of residential activity in the near term. I would say a weaker pace of home sales in the near term. The recent re-entrenchment in mortgage applications for purchases is a sign that home buying is likely to take another step back in the coming months. Yeah, go figure, right? If we have the number of people submitting loan applications to buy houses is at more or less the lowest level since 1995, that would imply that home sales are going to decrease greatly for the remainder of the year here. Wells Fargo also says that financing costs to buy houses are likely to remain elevated compared to recent history though. Even if rates drop, a deteriorating macroeconomic backdrop marked by higher unemployment and slower income growth will serve to keep the pace of home sales relatively sluggish. We look for the pace of existing single-family home sales to rise by a modest 4.4% in 2024 compared to 2023. In contrast, they're forecasting that new home sales will increase by 4% in 2024. Now, bearing this in mind, we now expect a slightly softer pace of home price appreciation in the years ahead. Higher financing costs are likely to both weigh on demand and constrain supply, which will allow home prices to maintain a positive trajectory. As such, we look at the S&P Case-Shiller Home Price Index to increase only by 1.8% this year, and then it increased by 2.5% in 2024, which is right here. Rise in prices based on the S&P Case-Shiller up by 1.8% this year is our forecast. 2024 up by 2.5%. Then in 2025, prices increasing by 4.4%. So that's our forecast for home prices. Here's our forecast for mortgage rates. So in 2020, the average rate, again for a 30-year fix, 3.18%. 2021, 3%. 2022, 5.4%. This year, they're forecasting overall for the entire year to be at 6.94%, then to decrease in 2024 to 6.39%, then to decrease further to 5.7% in 2025. In regards to their forecast regarding home sales of existing houses, again, this is according to the National Association of Realtors. Back in 2021, it was at 6.1 million. 2022, just over 5 million. Their forecast this year is at 4.2 million. In my personal opinion, that's a little bit high. My forecast is in the range of 4 to 4.1 million. They're forecasting 4.2 though. Then in 2024, a slight increase to 4.4 million. Then increase once again in 2005 to 4.7 million. I'd love to hear from you guys though. What do you guys think about their article here regarding potentially seeing a housing market recession? And of course, the real estate market predictions here through 2025. Please leave me a comment below. I appreciate you. Hope you have an awesome day. Like and subscribe, and I'll see you in the next video.